All right, so good morning. So what we are going to look at today is the consolidated, the group accounts, and then we'll start with consolidated statement of financial position. I will share my screen. I will do these videos for all the questions that is being shared in the question bank that is shared with you. So we'll just go straight to the first question. Let me share my screen right away to just some minutes. I'll be sharing my screen. Okay, all right. So I'm sharing my screen right now. So I'm putting forward let me put forward the question. Okay, so I'll zoom this out. So we are looking at question 2. Question 1 is basically the theory part. So that one, you can read up that one and then try to answer those questions. So question 2 is the beginning part of the calculation. We are required here to prepare the consolidated statement of financial position for Paul Group as at 31st December 20x4. So this is very basic. We are told that Paul Group acquired 100% of the equity share capital of Sol on 31st December 20x4 for 1 million naira. The financial statements of the two companies as at that date were as follows. So we are presented with the financial statement of Paul and also the financial statement of Sol. Paul is the parent company and Sol is the subsidiary company, and we are told that this is 100% ownership. So briefly, we look at the solution to this question too. If I go to the solution here, so you can see that here we have the financial statement of the two entities. So these are the financial statement of the two entities. So this is for Paul, and this is for what? And this is for Saul. So what we have to do here is to prepare the consolidated statement of financial. What we want to do here is the preparation of the consolidated statement of financial position. All right. So I will have to take out this computation so we can work on it on our own. So you see how we're able to arrive at each of them. All right. So the first thing is for you to prepare your group structure. So the group structure is very straightforward, right? So number one, the group structure is just to show the percentage ownership of the parent company in the subsidiary company. So here we have the parent company, which is Paul. Okay, so this is just how the group structure look like. The parent company, which is Paul, owns Sol. Okay, it owns what? Sol. And the ownership is what? The ownership is 100%. So this is just how the group structure looks like. So this is the first step that you have to take. Now, the second step that you have to take is to now work on the post-acquisition reserves. Okay, so you work on the post-acquisition reserves. The post-acquisition reserves is also very simple. Just have an heading. So this is Paul, and then you have the retained earnings. So you need to get the retained earnings at the date of consolidation. Sorry, this is the retained earnings at the date of consolidation. So retained earnings at the date of what? Of consolidation. Consolidation. So that's the retained earnings at the date of consolidation. So when you get the retained earnings of consolidation, you also get the retained earnings at the date of what? This is the date of at the date of acquisition. Okay, so when you find the difference between the retained earnings at the date of consolidation minus the retained earnings at the date of acquisition, you have the post-acquisition reserves. That is the DOC minus DOA. DOC is date of consolidation, DOA is date of acquisition. So all I need to do is to pick my retained earnings at the date of consolidation of the subsidiary, which is 750, right? And then we have been told that the date of consolidation, we have been told that the parent company acquired the subsidiary company on the date of consolidation. So the date of acquisition and the date of consolidation are the same. So what you need to do is to pick the reserves or the equity, the retained earnings at the date of consolidation as well, because it's still the same date at the date of acquisition. So if you look for the difference between the retained earnings at the date of consolidation minus the retained earnings at the date of acquisition, that will give you 0. That means that our post-acquisition reserves is 0. Okay, so basically what we are saying is the reserves, okay, reserves at the date. Sorry, so what we are saying here is the post-acquisition reserves, okay, is simply the reserves, okay. So we have it to be the reserves at the what? At the date of consolidation minus the reserves at the date of acquisition. So once you do this, of course, you put it in a bracket and then you multiply it by the cost of control, okay? So you have to multiply it by the cost of control percentage. So the cost of control percentage is the percentage ownership of the parent company in the subsidiary company. So that needs to be done here. So as you can see, we need to put this into brackets, okay? So somewhere here, we have to state our group structure, okay? I think that one is missing here. So we have to state your group what? We have to write out your group structure. So you have the cost of control. So cost of control of what? Of the parent company, which is Paul in Saul. Okay? Paul is Saul. That is what? That is 100%. 100 is 100 what? 100%. Okay? In this case now, our non-controlling interest, we've not gotten there yet, but obviously our non-controlling interest is 0 because there is 100% ownership. So 0%. So what we need to do here is to multiply. So I'll just put this in bracket to multiply this difference by the cost of control percentage, which is this 100%. So it will still give you what? It will still give you 0. All right. So that's fine. So we move to the consolidation schedule. Now, in the consolidation schedule, what we are looking at here is to be able to arrive at whether we have a goodwill or a gain on bargain purchase. Okay, I will get to that in more detail. We'll discuss that in more detail in subsequent questions. But for now, let's just restrict it to make it as simple as possible. So the first thing you have to get is to arrive at the net assets of the subsidiary acquired. So if you look at it, the net asset of the subsidiary acquired is made up of, if I put equals to there, is made up of the equity share capital of the subsidiary and also the what? And also the retained earnings of the subsidiary. So if I had the equity share capital and the retained earnings, it gives me the net asset acquired, which is 1,000. All right. So if you compare this net asset acquired to the cost of investment, which is also 1,000 naira. All right. So you have to deduct this. If I put this in jacket, okay. So if I put this in jacket, let me put it in jacket. So if I put this in jacket, okay, so that's a deduction. It then means that the goodwill is going to be nil. So if I add this to this, okay, the goodwill is nil. All right. Now, if you look at the post-acquisition reserves, do we have any post-acquisition? No, before you go to the post-acquisition reserves, under this cost of control here, all right, under under this heading, which is the cost of control here, we need to include the ratio, okay? The ratio of the cost of control. You can see that the ratio here is 100% ownership. So basically what we'll do is to say equals to, you pick the 250 that is here, you multiply it by this 100%, the 100% control. So let me take out the yellow so that we can see it properly. Okay, so just say equals to, you pick the 250 that is here, times multiply it by the cost of control up here, which is this 100%. All right, so multiply it by that 100%. Okay, so if you multiply 250 by 100%, it gives you 250. So also multiply 750 by 100%, it also gives you 750. Yeah, so 750 plus 250 will give you 1,000. All right, so it's basically just the same. So the cost of investment as well. These are our cost of investment. Is going to move here. Then what happens is that our goodwill is zero. Okay, so our goodwill becomes zero. Now, for the non-controlling interest, obviously we do not have non-controlling interest. Okay, so the equity share capital, okay, for the non-controlling interest is going to be at the date, the equity share capital at the date of consolidation. So I'm going to pick this 250 to solve, and then I'll multiply it by the NCI percentage, which is just 0%. So once you multiply that, you have this to be 0. All right. And then for the retained earnings, the retained earnings at the date of acquisition. So I'm going to pick the retained earnings at the date of acquisition, which is this, multiplied by the NCI percentage, which is this. Remember that we don't have any NCI. So we are just leaving this space there in case we have an NCI. All right. So that is it for that. So the goodwill is 0. Now you should normally have a space here. Should you have an NCI? So this is the NCI. Now basically, I know that I don't have any NCI. So if I sum this up, so my NCI there is just 0. So I know that I don't have any NCI. So now I have to pick the parent company's reserves. So if you look at it, the parent company's reserves at the date of consolidation. The parent company's reserves at the date of consolidation is 1,100. So I pick the 1,100 and then I drop it here. So if you add the post-acquisition reserves, which is what we have calculated here, remember that of the post-acquisition reserve, we subtracted the retained earnings of the subsidiary at the date of acquisition from the retained earnings at the date of consolidation to arrive at the post-acquisition reserve, and then we multiply it by the cost of control, the percentage ownership of the parent company in the subsidiary company, which is 100%. Okay, so that gave us the post-acquisition reserves. And then we move this post-acquisition reserves to the consolidation schedule under the consolidated profit or loss. Then what we then do again is to add the parent company reserves to it. So once we add 0 to 1, it gives us 1,100. Right? So after that, the next thing you then need to do is to prepare your consolidated statement of financial position as at 31st December 2004. All right? So that's pretty straightforward. We just add it line by line. Okay, of course, you have your other assets. So that is 1.5, 1.5 plus 1.2. Okay, yeah. So that's your 1.5 plus 1.2, which gives you your 2.7. Yeah, this is the parent company. This is the subsidiary company. So we don't have anything for what I will just do here is I will give this a heading. So this is Paul, and this is Saul. Okay, so this is for Paul, and then that is for Saul, and then this is the consolidated. Okay, so that's the consolidated. All right. So the investment in Soko, we are not going to make use, we are not going to include the investment, the amount of money or what is paid by the parent company to acquire the controlling interest in the subsidiary company. Why? Because we've made use of this 1 million in arriving at whether we have a goodwill or a gain on bargain purchase, whichever case it is. So this 1 million that is here has been used in exchange for the net assets, for the interest or the interest in the net asset of the subsidiary. Okay, so we are not going to take it into consideration in the consolidation. So just add 1.5 plus 1.2 gives you 2.7. Okay, and then your equity share capital. Now, for the equity share capital to be consolidated, it is that of the parent alone. So I will just pick the parent alone, which is 1,000. Yeah, and then the consolidated retained earnings. The consolidated retained earnings is going to be what we arrived at here. You can see that here we have the consolidated reserves. Sorry, so you can see. So I will just pick the consolidated reserves here, which is this one. That will be my consolidated retaining. So once you pick that and then you add it up, it gives you 2.1. So the last is the liabilities. The liabilities is also very straightforward. Just pick your 400 plus your what? Plus your 200. And that gives you 2.7. So you can see that our balance sheet, this minus this, our balance sheet is what? It is balanced. Okay, so that's how you prepare a very simple consolidated statement of financial position when there is 100% acquisition at the date of consolidation. So this is 100% acquisition at the date of consolidation. Now let's go to the second question. So I'll quickly look at the third question. Okay, so the third question says that H acquired the entire share capital of S Limited on 31st March 2005. The balance sheets of the two companies. Okay, the balance sheet of the two companies were as follows. No, I think that should be what we should be looking at. Sorry. So this is what we should be looking at. This is what we just looked at. Sorry. So what we should be looking at is question 4. Okay. So question 4 says that the facts are the same as in question 3 above, except that H acquired 80% of the equity share of S on 31st March 2005. So here we are having non-controlling interest. So we are introducing non-controlling interest here. Later on in the question, as we move on to further questions, we will see that there are two ways of valuing non-controlling interest. It's either you use the proportion of the subsidiary net asset acquired, proportionate share of the subsidiary net asset acquired, or you use the fair value method. Okay. But in this case, what we are going to be using, of course, is the proportionate share of the subsidiary net asset acquired. So later on, we are going to be looking at the fair value method. Okay, so let's briefly look at the question 4. Okay, so they say that the facts are the same as in what we have here. So basically, I will copy what I have here. Let me paste it here on the sheet that has the question 4. So what we want to do here now is to look at A situation where there is a non-controlling interest, where there's a non-what? Controlling interest. Now, we have been told that in this case now, the companies involved is HCO, and S. Sorry. So HCO and SCO. Okay. So what do we do here? So this is H, the cost of control, which is the good structure, the cost of control of H in S. So the cost of control of H in S is what? In this case, look at the question. We've been told that it is what? 80%. So if it is 80%, automatically you can see that our non-controlling interest will be 20%. That's 100% minus 80%. All right. So what do we do here again? We prepare our post-acquisition reserves. So these are our post-acquisition what? Reserves. So the heading here, I can just give it an heading here. Post-acquisition reserve. So here we are preparing our post-acquisition reserves. Okay, which is simply the reserves at the date of consolidation minus the reserves at the date of acquisition times the cost of control percentage. All right. Now, in this case, we are told that the acquisition is still at the same date as the date of consolidation. So there is no post-acquisition reserves. And because there's no post-acquisition reserve, it still remains zero. So the calculation we have done here is still valid. That's why this is zero. All right. So the next thing is our what? Is our consolidation schedule. All right. So the next thing is our consolidation schedule. Let me remove the green lines on it. So the next thing is our consolidation schedule. So when we come to our consolidation schedule, of course, we still have our heading for cost of control, non-controlling interest, non-controlling interest, and then for consolidated profit or loss. Okay. So what then happens here? The non-controlling interest is now taking what? Instead of 0%, it's now taking 20%, while the cost of control is now taking 80% instead of 100%. So I'm going to pick this cost of control. I'll pick the 80% that is there. And then automatically, I know that my non-controlling interest is what? Is 20%, which is 100% minus 80%. So what then happens? In the equity share capital, I have 250 here, and then my cost of control, so here I'm determining the net asset of the subsidiary at the date of acquisition. All right. So my equity share capital becomes this 250 times 80%, which gives you 200. And then the retained earnings is 750 times 80%, which gives you 600. So if you add this up, it gives you 800. The cost of investment still remains 1 million. So you pick the 1 million. You are not multiplying the cost of investment by anything. That is the amount that the parent company pay to acquired controlling interest in the subsidiary. Okay. So if you look at the difference between these two, now you see that the net asset is 800 and the cost of investment is 1 million. It then means that the cost of investment, which is this 1 million, is more than the net assets. So anytime you have this situation, you are having a what? A goodwill. If the cost of investment, so what I'm saying here is that if the cost of investment, let me get my pen. So what I'm saying here is that if the cost, okay, of investment. So you need to take note of this. So if the cost of investment, if the cost of investment exceeds the net assets, okay, if it exceeds the net assets, if it exceeds the net assets of the subsidiary, okay, okay, at the date of acquisition, okay, what you will have is a what? You have a goodwill. So that's what you are going to get. Now, if the cost of investment, this cost of investment now is less than the net assets at the date of acquisition, what you will have, so the same thing here, the same thing here. So what you will have is a what? A gain on bargain purchase. Okay, so we are going to see more examples on goodwill and gain on bargain purchase later. Basically, what you do is that this goodwill is taken to non-current asset and is tested for impairment, while this gain on bargain purchase is what is taken to the consolidated P&L. So we are going to see examples of that. All right, so that's what we will do there. All right. Now, so this 200 that we have here is our what? Is our goodwill. Our NCI now becomes 200. Why? Because we have NCI here. NCI is 20%. Okay? NCI is 20%. And then this picks this 20% times, okay, the equity share capital, that will be 20% times the equity share capital at the date of consolidation. Okay? So that gives you 50. All right. Then for the retained earnings, it has to be the retained earnings at the date, emphasis on that. The retained earnings at the date of acquisition times the non-controlling interest percentage, which is 20%. And that gives you 150. So if you add 150 to 50, you have 200. All right. So, sorry, I will have to change this. So this is SO, and instead of O, this is what? This is HO. So what you now do is to transfer HO reserves. So just put HO reserves here, and then you add it up. Okay, remember that we still don't have post-acquisition reserves, and that's why this place is 0. You can see we pick it directly from the post-acquisition reserves here, and then we write it here. So this is post-acquisition reserves, and it is 0. So this becomes 1-1. Okay. So what you then need to do is to prepare your consolidated statement of financial position, not for Paul Group this time around, but for H Group. Okay, and the year is 2005. Okay, so what we'll do now is that the cost of investment, remember, we are not consolidating the cost of investment. This is it under Paul Group. So remember, we are not consolidating the what? We are not consolidating the cost of investment. Okay, so that remains as it is like this. Okay, so here, other assets, you can see other assets. So other assets, we had it just line by line. Okay, so that is it here, 27. Okay, now what you now need to introduce, let me take out this other line again. Sorry. So what you then need to introduce, so what you then need to introduce, I think I can just do it. So what you then need to introduce is the goodwill. Okay, remember, we have calculated a goodwill here. So we pick this goodwill. All right. So the goodwill that we have calculated there is what? Is 200. So you can see it's not this one. This one is what is coming directly from the SOFP. While this one, we have applied the 80% on it. So you pick the goodwill, which is the 200. Okay. So if you add this to this, it gives you 2.5. So that should be 2.9. Okay, so what we do is to remove the jacket there. So, all right. So it's not negative, it is positive. Okay. So that gives you 2.9. Remember that though this one is showing negative figure here, but it is actually a positive figure. Okay, so emphasis on that. Okay, so I can as well just put my minus here to remove that negative, and then this automatically becomes a positive figure. All right, so this is a goodwill and it's positive. All right, even though when you subtract 800 from 1,000 from 800, it gives you negative, but it's a goodwill, so it's just leave it as a positive figure. All right, so that's 29 there. So what do we do here? In the equity share capital, we have this and we have this, right? And then you have to introduce your NCI. So this equity share capital to the parents. Owners of the parents. So that's to the owners of the parent company. Okay. And then you now have your what? Your NCI, the non-controlling interest. So the NCI that you have calculated, you just go ahead and then you pick the NCI that we have calculated. So the NCI we have calculated is 200. So we pick the 200. Are you getting that? So we pick the 200. Okay, of course, you still have your liabilities. You add it up line by line, which is 600. So, and then you can see that it is balanced. So this is 29 and this is 29. And our account is what? It's balanced. So that is it for so that is it for the consolidated statement of financial position, considering the non-controlling interest. So the key point to note here before we round off with this class is that number one, okay. So number one is that you must have your group structure. Okay, that is given. So you have your what? Your group structure. Your group what structure? I don't like this pen. Let me change the pen to black. So you must have your group structure. So your group structure will tell you parent ownership. Okay, parent ownership, in subsidiary. Okay, P ownership in S. Okay, so once you do that, if you assume, let's say that one is 51%, okay, it then means that your NCI will be what? 49%. Are you getting me now? So you must have that. And then number two is that you must prepare a table to show your post-acquisition reserves. Okay, your post-acquisition reserves. And basically, your post-acquisition reserves is very simple. It is just your reserves at, it is just your reserves at the date of consolidation minus your reserves at the what? The date of acquisition. So whatever figure you get here, let's say it is excess amount, you have to multiply this figure by the cost of control. So this cost of control percentage we are talking about here is this 51%. Okay, so that's the principle we applied there. And then we also went ahead to now prepare our consolidation schedule. Okay, number three, we went ahead to prepare our consolidation schedule. And what do we talk about in the consolidation schedule there? First, we have to determine the net assets, okay? The net asset of the subsidiary, okay? At the date of what? At the date of acquisition. So we got the net asset of the subsidiary at the date of acquisition, and then we compare it to the cost of what? To the cost of the investment. We compared it to the cost of investment. And then we now say that if the cost of investment is greater than the net assets, okay, what do we have? We have what? we have a goodwill. And the second is that if this cost of investment is now less than the net asset, what do we have? We have a gain on bargain purchase. And then we said that this goodwill is not amortized. You do not amortize this goodwill, but you test it for impairment. So when there's an impairment loss, it will reduce the carrying amount of goodwill, and then you charge that impairment loss to your consolidated profit or loss. All right. When there's a gain on bargain purchase, immediately you transfer that gain on bargain purchase to the consolidated profit or loss. So that's the treatment for that. And then we now talk about the situation where we have the NCI. So when we have the NCI, we are going to calculate the NCI percentage, the NCI portion of the net asset of the subsidiary. And then for the equity, we take the equity at the date of what? The date of consolidation. All right, that's the equity capital. But the retained earnings, you take the retained earnings at the date of what? At the date of acquisition. Okay, so you are going to add up these two to get the NCI share of the subsidiary's net assets. So that will give you the NCI share of the subsidiary net asset. And this NCI share of the subsidiary net asset is using the proportionate share of the subsidiary net asset method. And then we said that later on, we are going to look at the fair value method of valuing NCI. So that's where we are going to end this section of this question now. I'll see you in subsequent videos where we shall be looking at more advanced, where should I be proceeding with this and look at more, I'm looking at more questions where we are going to be treating more scenarios, including the goodwill, gain on bargain purchase, impairment loss, and others. All right. And then also looking at post-acquisition reserves as well. So thank you and see you in the next class.